After 25 years of negotiations, the EU and Mercosur bloc, Argentina, Brazil, Paraguay, and Uruguay, have reached a historic trade agreement, Brussels' biggest yet. But while politicians celebrate, EU farmers worry about its impact. Is this a game changer or a ticking economic time bomb? And that's just the start. We'll also look at Poland's unexpected rise as 2024's biggest gold buyer, explore whispers of a European Central Bank rate cut, and break down why the US is turning up the heat on Mexico and Canada over trade disputes. So, let's dive into these topics. The new EU-Mercosur trade deal, covering a whopping 780 million people, is about to unlock a massive market of 280 million Latin American consumers for European businesses. A fun fact is that over 30,000 European companies are already operating in the region. And with customs duties of 10% to 35% set to gradually disappear, exports in wine, spirits, and dairy are poised for a major boom. The EU is already Mercosur's second trade and investment partner after China. In 2023 alone, EU exports to Mercosur totaled $56 billion in goods and $28 billion in services. Add to that an investment stock of $340 billion as of 2021, and the partnership looks solid. However, challenges remain, as exporters and investors still encounter notable hurdles in accessing Mercosur markets. So, what's the plan? The EU-Mercosur agreement aims to boost trade and investment by removing tariff and non-tariff barriers, especially for small and medium-sized businesses. It introduces stricter rules on intellectual property, food safety, and fair competition. The deal also upholds shared values such as sustainable development, workers' rights, and the fight against climate change. Companies are required to meet high standards and act responsibly. For the first time, the EU has introduced a rebalancing mechanism that allows either side to seek compensation if new policies undermine the agreement's benefits. Could this give Mercosur grounds to challenge the EU's carbon tax or bans on imports from deforested lands? That remains to be seen. Both sides agree that climate change is a global challenge requiring broad cooperation. They have pledged to reduce greenhouse gas emissions without harming food production, prioritizing the role of developed countries, while reaffirming their commitment to the Paris Agreement. But the deal isn't simple, especially on tariffs. Mercosur's duties on European cars won't disappear overnight. Reaching zero will take 18 to 30 years, with Argentina and Brazil keeping higher rates than Paraguay and Uruguay. Electric vehicles and hybrids, however, get a faster track. Tariffs will drop from 29% to 25% initially and hit zero within 18 years. Raw materials are where Brazil and Argentina score big. Brazilian exports of nickel, copper, aluminum, and other key materials to the EU will face zero taxes. Even if Brazil imposes export duties, they'll be capped, reduced by at least 50%, with a maximum rate of 25% for EU-bound goods. Meanwhile, Argentina will scrap export taxes on raw materials, but keep duties on agricultural products. So, what's the catch? The agreement has sparked significant backlash across Europe. France and Poland have been particularly vocal, and the Dutch parliament passed a resolution opposing the deal. Austria has outright vetoed it, while Ireland, Italy, and Luxembourg have voiced serious reservations. Critics argue the agreement fails to address the environmental and social consequences, especially as far-right movements threaten to derail global climate action. It's not a done deal yet, warns Audrey Chango, a vocal critic of the pact. With growing opposition on both sides of the Atlantic, civil society will continue to push back against its implementation. So, is this a leap forward for global trade? Or are we glossing over the environmental and social costs in favor of economic gains? Only time will tell. Now, while the EU and South America are working on a major trade deal, some surprising moves are happening elsewhere in the global economy. Let's talk about a country that has caught attention with its impressive gold reserves. Poland is turning heads in the gold market, buying a whopping 100 tons of gold in 2024 alone. That makes it the biggest sovereign buyer of the year. By the end of the year, Poland's gold reserves hit an impressive 427 tons. So why all this gold? According to the head of Poland's central bank, Adam Glapiński, it's simple. Gold is like an economic safety net, a shield against potential disasters. We're entering the exclusive club of the world's biggest gold owners. Glapiński proudly announced recently his goal is to make gold 20% of Poland's total reserves. And it's not just Poland joining the gold rush. The Czech Republic, Hungary, and Serbia are also stacking up their reserves. The Czechs, for instance, already have massive foreign reserves worth nearly half their GDP. Although some critics think buying gold during its peak price is risky, officials argue that they're in it for the long haul to balance market ups and downs. Hungary is another big player, adding 10% more gold this year, bringing its stash to 110 tons. Prime Minister Viktor Orban, who's known for shaking things up in the EU, sees gold as more than just financial security. It's part of Hungary's history. Meanwhile, Serbia isn't holding back either. President Aleksandar Vučić has made it clear. Any extra cash the government has will go straight into gold. Since 2012, Serbia's gold reserves have tripled to 48 tons, and they're not stopping anytime soon. So, why is everyone so obsessed with gold right now? It's pretty straightforward. With inflation on the rise, global politics getting messier, and economies facing constant uncertainty, gold is seen as a safe bet. And the experts agree. Goldman Sachs predicts it could hit $3,000 an ounce by the end of 2025. For countries like Poland, Hungary, and Serbia, gold isn't just about money. It's about security, independence, and showing the world they can stand strong no matter what happens. Speaking of Europe, it's not just Poland making headlines. Over in the Eurozone, the central bank is gearing up for another big decision, one that could impact millions of businesses and households. Let's break it down. On December 12, 2024, the European Central Bank, ECB, reduced its three key interest rates by 25 basis points. The deposit rate was lowered to 3.0%, the main refinancing rate to 3.15%, and the marginal lending rate to 3.40%. This marks the third rate cut in a row as the Eurozone faces slowing growth and cooling inflation. With inflation easing and the economy underperforming, many economists believe the ECB will keep cutting rates into 2025. For example, Bank of America predicts the ECB will trim rates at every meeting until September 2025, when the deposit rate could hit 1.5%. Their reasoning? The economy is expected to grow at a sluggish pace, which makes it hard for the ECB to stop easing until rates drop below the neutral level of 2%. Danske Bank and Goldman Sachs agree. They forecast steady cuts, with Goldman expecting a deposit rate of 1.75% by mid-2025. In fact, ECB President Christine Lagarde might even hint at another rate cut in January. Now, what about inflation? The European Central Bank recently released updated economic forecasts. According to the new data, inflation in the Eurozone is expected to reach 2.4% in 2024 and 2.1% in 2025. Growth projections were also revised. The Eurozone's GDP is estimated to grow by 0.7% in 2024 and 1.1% in 2025. These forecasts indicate a slower economic recovery than previously anticipated. Falling inflation and sluggish growth may encourage the ECB to continue its policy of cutting interest rates to support the economy. However, as ECB President Christine Lagarde emphasized, despite inflation nearing the target level, the regulator intends to act cautiously, considering persistent pressure in the services sector and rising wages. What does this mean for the euro? The answer is simple. Lower rates usually weaken a currency, and that's a concern for the euro. Analysts like ING's Chris Turner believe the euro could continue its bearish trend, especially if economic data and global tensions weigh on the currency. A weaker euro could benefit exporters by making European goods cheaper abroad. However, it also makes imports, like energy and raw materials, more expensive, which could hurt businesses relying on those goods. The goal of cutting rates is to make borrowing cheaper for businesses and households, encouraging spending and investment. For small businesses, which depend heavily on bank loans, cheaper credit could provide a boost. The real estate sector could also benefit. As mortgage rates fall, more people might consider buying homes, potentially reversing the slowdown in home sales. Additionally, households might feel more confident spending on big purchases like cars or home improvements. Export-heavy industries like automotive and machinery could also gain from a weaker euro, as their products become more competitive in global markets. That said, not everything is smooth sailing. A weaker euro raises the cost of imports, which could offset some of the benefits of lower borrowing costs. Geopolitical issues like the war in Ukraine, tensions in the Middle East, and potential US tariffs could also dampen business confidence. Even with cheaper loans, companies might hesitate to invest in such uncertain times. In the end, while the ECB's rate cuts are designed to support the economy, their success depends on how businesses and consumers react and how global events play out in the months ahead. While Europe wrestles with growth challenges, the US has been busy with its neighbors. Mexico and Canada are in the crosshairs, and it's all about trade. Some say that the US is becoming more and more protectionist, and it's not just about China anymore. It seems their strategy is clear: protect the US economy by making imported goods so expensive that American consumers are pushed to buy products made in the US. With his latest move, Trump reinforces this approach. He announced plans to impose a 25% tariff on all goods from Mexico and Canada, as well as an additional 10% tariff on goods from China. He intends to sign the corresponding executive order on the first day of his presidency, January 20th, 2025. This move sends a clear signal: no country is safe from his trade policies. So, what's the impact so far? The US dollar surged, climbing 1% against the Canadian dollar and 1.6% against the Mexican peso. Meanwhile, Asian stock markets took a hit, and European markets opened lower. The S&P 500 futures, however, remained relatively steady. Trump is serious about these measures, framing them as a fight against illegal migration and drug smuggling, particularly fentanyl entering through Mexico and Canada. Tensions are rising. Canadian Prime Minister Justin Trudeau reportedly met with Trump, arguing Canada shouldn't be lumped in with Mexico on border and drug issues. Meanwhile, Mexican President Claudia Sheinbaum hit back, highlighting Canada's fentanyl problem and accusing the US of dragging Mexico into its elections. After speaking with Trump, Sheinbaum remained optimistic, saying there will not be a tariff war, while stressing Mexico's efforts on migration and trafficking. However, experts suggest Trump's real aim is to undermine the USMCA trade deal, preferring bilateral agreements with Canada and Mexico instead. Economists warn that if these tariffs take effect, they could return US duties to 1930s levels, fuel inflation, and disrupt global supply chains. Retaliation is likely. Mexico has hinted at counter tariffs, and Canada may follow, risking major economic fallout for all three countries. Still, Trump's habit of making bold threats before negotiating a deal leaves room for doubt. As economist Wagner put it, tariffs are a very imperfect solution, but history makes it hard to dismiss the threat entirely. Trump slapped tariffs on steel and aluminum from both Canada and Mexico during his first term, and as Schott points out, he did it before, and he'd do it again under the right circumstances. 2025 promises to be an exciting year for the global economy with events like these. So don't forget to HTI the like and subscribe to the channel to stay updated on the latest global news. Thank you for watching, and see you in the next video.